Hello everyone, welcome to the 25th episode of me learning how to trade using Forex. So in the last episode we went through the advanced risk management course on the official forex.com, and we went through the scaling in and out trades and how to trade and how to handle news of an open trade, and now we're currently doing the correlations and risk management. So yeah, let's get started. Below I shouldn't have added that in, because we're just carrying on from before, aren't we? So, correlations and risk management. Financial markets rarely move entirely in isolation. A trend in one asset will often ripple around several others, meaning some prices rise and others fall. So, financial markets rarely move entirely in isolation. A trend in one asset will often ripple around several others, meaning some prices rise and others fall. Let me just delete this row. This effect is called market correlation. While it can be useful for spotting opportunities, it can also increase your risk if you aren't careful. But by understanding how correlation works, you can take a significant step towards lowering your overall risk. So, what is market correlation? Market correlation is a measure of how much assets move in line with each other. Market correlation measures how much assets move in line with each other. You can measure the correlation of specific markets, industries, or entire asset classes. Correlation is usually measured as a percentage. If two markets are 100% correlated, then their movements will always be the same. When one rises, so will the other. This is called a perfect correlation. This is perfect correlation. This is called a perfect correlation. So we can see that the blue and the yellow, move the same. So it goes down, blue goes down, the yellow goes down, goes up, the yellow goes up, blue goes, and it pretty much mirrors. The yellow pretty much mirrors how the blue is moving. So the FTSE 100 and a FTSE 100 CFD should have a 100% correlation. For example, because a FTSE CFD would always mimic the price movements of its underlying market. A 50% correlation, meanwhile, means that the two markets generally move in the same direction, but may not always follow each other in lockstep. Correlation means the two markets generally move in the same direction, but may not always exactly follow each other. Stocks in the same sector may show very high correlation rates, which can make it difficult to find a share that outperforms its peers. Forex pairs are also often highly correlated, especially when they feature the US dollar. In the same Forex pairs are also highly correlated, especially when they feature USD. Types of correlations. There are three types of correlation: positive, negative, no correlation. Positive correlation describes markets that mimics each other's movements. Negative correlation describes markets with inverse movements. No correlation describes market with no relation whatsoever. Yep. So three types: correlation, positive, markets which mimic each other's movements. Negative, markets which inverse each other's movements. No correlation, no relation whatsoever. So minus 60 to minus 100, strongly negative. Minus 20 to minus 60, slightly negative. Minus 20 to 20%, essentially uncorrelated. 20 to 60, slightly correlated. So the key ones are 60 to 100, minus 20 to 20, and minus 60 to minus 100. So positive, which is around 20 to 100. Negative is minus 20 to minus minus 20 to minus 100. So 100%. Minus 20 to minus 100%. No correlation, which is 20 to minus 20%. Okay. Why correlations are important. The correlations can have a significant impact on your overall risk level and your bottom line, chiefly because they act against diversification, and can mean that one market moving against you impacts your entire portfolio. So correlation can have a significant impact on your overall risk level and your bottom line. On your overall risk level and bottom line. Because they act against diversification. And I think diversification means that when you here means that you spread something out so that if one thing goes wrong, then it won't affect the others. But correlations means if one thing goes wrong, then it can cause others to go wrong as well. Which is why hence acting against the diversification. So and can mean that one market. Meaning one. For example, if you have an open short position on two markets with a 75% positive correlation, then it is probable that a bear trend in one will lead to the same move in the other. In this case, you risk losing the capital allocated to both positions if one moves against you, so your total risk from the trade could be higher than you originally planned. If you have multiple correlated positions, then your overall risk on the portfolio level could be far higher than you think, so it's always worth researching which markets are related and which can add to your diversification. So, positions, your risk level could be higher than you think. To your diversification. Profiting from correlations. You can also use correlations to target profits. One stock trading strategy, for example, involves finding correlated companies and monitoring their price action. If one stock diverges from the rest, you can take a position on its eventual return to the norm. Volatility can have an impact on correlations. In times of high volatility, markets tend to become more correlated, which may increase your overall risk. Oh, okay, so correlations. Markets tend to become more correlated. A few key market correlations. Some correlations are only temporary, others have lasted for years and look set to continue. Here are some common examples to be aware of in your trading. USD and gold. Perhaps the best known correlation of all is between the US dollar and gold. Gold is priced in US dollars, so its price is hugely dependent on the strength of the currency. On the strength of the currency. When USD rises, gold prices often fall, a strong negative correlation. Is that why I think in the earlier courses they were saying that when the economy is bad, people will often buy gold instead of others, because if the economy is bad, then I'm assuming the USD the strength of USD is going to be affected, so it might fall. Therefore, if it's a strong negative correlation, then gold prices will rise. Hence why they buy gold at that time. So AUD slash USD and copper. Lots of currency pairs are closely correlated to commodities. This usually occurs when an economy is dependent on commodities to grow. Australia, for instance, derives a large portion of its wealth from metals mining, so the price of AUD/USD can move as copper prices move. Can move as copper prices move. USD slash NOK and Brent crude. USD slash NOK on the other hand has an inverse correlation with the price of Brent crude. Why? Because Norway is one of the top exporters of Brent, which accounted for some 18% of its GDP in 2018. So inverse meaning negative correlation here, where the price of Brent crude has an inverse. Top exporters of Brent. Stocks and commodities. If a company is dependent on a particular commodity for its operations, then its share price is highly likely to be correlated. Is dependent. Likely airlines, for example, are huge consumers of oil. When oil's price is high, they may suffer, which plays out on the markets. Miners, on the other hand, will make more profits when metal prices are high, so some traders use this to get indirect exposure to metals. Instead of investing in commodities, they buy mining stocks. They buy mining stocks. Right, okay, so I think that's done. Market A has a minus 100% correlation with market B. A begins a bear run. Opposite, a bear goes down. If it's a downward trend, B will move up. Oh no. Bear goes up. Sorry, bear goes up. Bull goes down. So it will go down. Market C has a 50% correlation with market D. If C goes in a bull run, what will happen to D? Impossible to say. No, wait. Has a 50% correlation. If bull goes down, or move up, I guess. Yeah, there we go. Right, okay. That is advanced risk management done. Very nice. The next one, advanced. Let's see. Whoops. Advanced risk management. Advanced technical analysis. Let's go. So this is technical analysis, and the date is 25/01. Enter 2024. So pivot points. Welcome to the advanced technical analysis course. In these lessons, we're going to cover some additional indicators, tools, and patterns you can use to find opportunities. Let's start with a useful way of finding support resistance levels, pivot points. Support and resistance levels. What are pivot points? Pivot points are a technical indicator that traders use to predict upcoming areas of technical significance, such as support resistance. Used They calculated by averaging the high, low and closing prices of a previous period. Closing prices of a previous period. That could be a day, a week or a month. If a market is trading above its previous pivot point, known as P, it is seen as a bullish signal. If it's below, it's a bearish. Pivot point P. It's seen as a bullish signal. If it's below, it's bearish. Day traders often use this as a method of spotting short-term trends. For instance, if EUR/USD is trading above P from the previous day, they may decide that it will continue to climb and look to buy the pair. Finding support and resistance of pivot points. Wait, so it's trading from above P. If it's above, bullish, and you buy with the bulls. Because bulls go up, so it's an upward trend, so buy. Right, okay, finding support or resistance with pivot points. However, P isn't just used to gauge today's price action. It also forms a basis of 6 further calculations to identify possible areas of support and resistance known as S1, S2, S3 for support, R1, R2, R3 for support. Just used to today's price action. Also forms the basis of 6 further calculations to identify possible areas of support resistance known as S1, S2, S3, R1, R2, R3. These levels appear on a chart as parallel lines to P and can be used as profit targets or areas to open new positions. For resistance. And let's get this beautiful diagram in here. I want to see more detail what this is showing. So zoom in for a bit. Okay, resistance 1, resistance 1, resistance 2, resistance 3. Pivot points here. Pivot S1 support, support. Pivot S1 R1 S3 support 3 support 4 support 5. Oh, there's loads of supports in here. I thought it only goes up to support 3. Huh? Wait, let's have a read on. These new levels appear on a chart as parallel lines to P and can be used as profit targets or areas to open new positions. So used or areas to open new positions. Pivot points example. Let's take a look at the Dow Jones's example. The Dow is trading below its previous day's P, which offers a short-term signal that a bear run may be forming. You decide to short the Dow at its current price. So, You could aim for S1, S2 or S3 as a profit target. Just like some other support levels, these will be seen as stronger if the market has bounced off of them before. If S1, S2 or S3 lines up with a previous support area, it could make for a good target. Alternatively, you could wait for the dough to bounce off support at say S1 and buy the reversal. If you did this, P or R1 might make a good profit target. So by buying the reversal, that just means shorting again, right? Right, okay. Right, so calculating pivot points. You don't need to calculate pivot points manually when trading on Forex.com platform. To view them on the chart, simply log in, select your market and pick pivot point standards from a list of indicators. However, to work out P for yourself, follow these 3 steps. Find the high, low and closing points of the previous day, week or month. Add them all together and divide the results by 3. Highlight this price on your chart as P. The months behind S and R levels is a bit more complex. R1 equals P times 2 minus the previous low. R2 is P minus S1 plus R1. R3 is P minus S2 plus R3. S1 is equal to P times 2 minus the previous high. S2 equals P minus R1 minus S1. S3 equals P minus R2 minus S2. Pivot points fact sheet. Type indicator, used in any condition, used for predicting bull or bear trends, identifying future support and resistance, markets any, timeframes any. Cool. Andrew's pitchfork. Monitoring trends isn't always an easy feat. Thanks to the multiple highs and lows of market may experience with a broader move. Andrew's pitchfork provides a useful method to identify and outline any deviations from the main path of a trend, as well as providing a channel that offers support, resistance, and a medium line. What is Andrew's pitchfork? Andrew's pitchfork is a drawing tool that you can access on Forex.com charts. It takes a form of 3 lines, a medium line plus an upper and lower line equidistant from it, aka the same distance from the medium line. You can use these to highlight future support, resistance, possible upcoming breakouts and more. Alan Andrews invented the pitchfork back in the 1960s as a means of predicting how much a market might deviate up or below its primary trend. So just drawing 2 lines. Monitoring trends. Drawing tool. Takes the form of 3 lines. 2 a medium line plus 2 plus an upper lower bound plus an upper and lower bound line equidistant from the median line. You can use these to highlight future support, resistance, possible upcoming breakouts and more. Alan Andrews invented the pitchfork. Yep. Okay, so drawing Andrews pitchfork. To draw Andrews pitchfork, you connect 3 points on the trending markets chart. The first, A, marks the beginning of the trend. The second, B, is its reaction high when it hits a peak before counter trend forms. The third C is this reaction low when the counter trend ends and reverses. We can see the pitchfork here, I'm guessing. So what is it? From the median line, you can use these to highlight future support resistance, possible upcoming breakouts, and more. So can be used to highlight future support and resistance. And more. As a means of predicting how much a market might deviate up or down below its primary trend. Can be used to predict how much a market might deviate up or below its primary trend. Drawing Andrew's pitchfork. Let's just write that down. A trend. B is its peak is the trend peak before counter trend forms. Third C, when the counter trend ends and reverses. Once you have selected these 3 points, you'll see the 3 lines on your chart. They look like a pitchfork, which is where the tool gets its name. Right. Tip, you don't have to draw the pitchfork in the order listed above. If your market hits its reaction below its reaction low before its reaction high, then selecting point C from before point B will work just as well. Right, okay, so however, don't have to draw the pitchfork in the order listed here. Using Andrew's pitchfork. If you have drawn your pitchfork correctly, then the median line should follow the broad trend, which is that one there. The upper and lower lines act as support resistance levels, sending the price back towards the median. Yep. Occasionally, the median line itself can act as a support or resistance. When either of the outer lines is broken, a breakout could be on the cards. This may signal the impending end of the prevailing trend. So, consists of 3 medium line plus an upper lower bounce. Can be used to form future support levels. Occasionally, the median line itself can act as support resistance. When either of the outer lines is broken, a breakout could be on the cards. So, it's broken. This may signal the impending end of the prevailing trend. Okay, examples. Bullish EUR USD fork. In this EUR USD example, the initial trend started at A, yep. Then hit reaction low first at B, yep. It then bounced up to a new peak at C, yep. Giving these 3 points required to draw a pitchfork. The lower support line from B is correctly anticipated where the market bounced up several occasions, except for this bit here. When the market broke the resistance lines from C, a breakout and acceleration out of this established trend ensued. When the market broke from the resistance line from C, a breakout and acceleration out of the established trend ensued. Bearish CADs, USD CAD fork. You can use Andrew's pitchfork to both uptrends and downtrends. Here we've drawn one on the downward trending USD/CAD chart. First, the market hits a significant bottom at B, so here. It then reached a peak at C. As you can see, the medium line provided support. Now it is broken, the lower B line may become a new support level. Right, okay, so extending the pitchfork. If a prevailing trend accelerates beyond either of the prongs of the fork, then you might need to consider adding an extra line to extend the channel. If the prevailing trend accelerates beyond, beyond the beyond either prongs of the fork, then you might consider adding an extra line to extend the channel. So in here we can see one of the added lines is probably C here. To do this, simply draw another parallel line in the direction of the breakout. Add another remove from the distance. At another remove from the distance between the upper lower line and the median. Yeah, because you can see the original pitchfork here, and then the new one is added as C. So simply draw another parallel line in the direction of the breakout at another remove from the distance between the upper lower line and the meridian and the median. So direction of the breakout at another remove from the distance between the upper and lower line and the median. Right, okay. Andrew's pitchfork fact sheet. Type drawing tool, used in uptrends or downtrends, used for identifying future support resistance within a trend, markets any, time frames any. Cool. Alright, I am going to leave this episode here. So thank you for watching, and I'll see you guys in the next video, which is the average true range. So yeah, peace out guys.